In modern investing, private equity and hedge funds stand as sophisticated strategies for the discerning investor. This segment delves into these dynamic investment vehicles, exploring their potential in today's economic landscape. Private equity, encompassing venture capital, growth equity, and buyouts, offer direct investment opportunities into the burgeoning world of private companies. From nurturing innovative startups to transforming established enterprises, private equity is reshaping industries. Hedge funds, known for their diverse strategies, including equity-related and event-driven approaches, seek to generate active returns. They adapt swiftly to economic changes, increasingly focused on digital transformation and sustainable practices. These investment forms are not without their complexities. They typically present a higher risk-return profile and require thorough due diligence. Access is often limited to accredited investors, and they come with longer lockup periods, demanding a strategic approach. As we explore these sophisticated strategies, we uncover their role in offering enhanced returns and diversification in modern investment portfolios, highlighting their appeal to investors seeking to go beyond traditional asset classes. So Gary, hedge funds, this is your area. The term hedge fund is so broad. It encompasses so many different strategies. I was just wondering, do you view it as high risk, high return, or is it conservative, seeking an absolute return?
So the last time I took a look at the industry, it was a few years ago. And at the time, there were something like 9,000 hedge funds. I don't know what that number is now. It's probably lower at the moment. But there were 9,000 examples. So some of them were high risk, high return. Others were, sector specific. Others were ultra hedged, leverage, no leverage. There are so many different strategies. And some of them provide, they do a really good, boring job at earning, slow and steady returns. So I don't know. I think, the sense that it was high risk, high return sort of came from the early days of the business where you had, guys like, Michael Steinhardt or Leon Cooperman who, they would swing hard and turn out great returns. And, they were larger than life characters. And I think that's where that came from. And they built up big names for themselves. Certainly the guys at Tiger have done extremely well in some concentrated portfolios with phenomenal research. But the industry really diversified over the following decades. And with 9,000 hedge funds or however many it is now, I don't know that characterization is still broadly applied.
I think probably a better way to describe hedge funds at this point is high fees, mediocre returns. I mean, if you're talking about individual investors, there are some brilliant hedge fund managers out there. At my old firm, we invested with some of them. We ran some hedge fund of funds. And I can tell you, as a business that was based on trying to research hedge funds and find those with some type of competitive edge, incredibly difficult. And if you could find them, whether they were willing to take your capital, to actually generate those type of returns, they have to constrain the amount of capital. And so as individual investors, I have no hedge fund exposure in my portfolio because I can't access the top tier hedge funds.
But
private
David,
capital
isn't
or
that
private equity is a little easier, but it's not easy to get access.
isn't that an inevitability, David, that if you're going to have 9,000 of these outfits, we're not in Lake Wobegon, right? They all can't be above average. So they all do charge high fees. So you're going to get that no matter which one you pick. 2 and 20 fee schedules are common. But clearly mediocrity by strict definition is exactly what you have to expect. So yeah, you're absolutely right about that observation. And it's an interesting conflict of interest, isn't it, that you're pointing out that their goal is to manage as much money as possible, to collect as much new money and to have that money grow as much as possible because that's how their fees are based. So they want to attract as many investor dollars, but the more dollars they attract, the harder it is for them to pick the few winners that are going to allow them to have outsized returns to brag that they're better than all the others. So it's it's a challenging world, and I'm not at all surprised to hear you say that you're not investing in many of them, if at all, because it's so difficult to find the good ones. And even when you find them, was it Groucho Marx said, I'd never join a club that would have me as a member. I would never have access to a club I'd want to be a member of, is kind of what you're saying. And it's unfortunately often too true.
Yeah, I think over the last decade, there have been two changes that have made it very difficult for hedge funds to continue earning the kinds of high returns they had in the earlier days. One is on the long side. The indexes are now concentrated, right? The top 5 or 6 stocks in the S&P 500 make up close to 30% of the index and pretty much all of their returns. And that makes it really difficult as a stock picker to outperform. The other thing is on the short side, and this is the part of the market that most people don't think about. But, I used to not just generate alpha, we used to make money shorting stocks. And the issue is, over the last couple of decades, there's been so much of a flow toward index funds and people indexing that basically the more overvalued a stock is, the larger a part of the index they are. And as money flows into those index funds, the more money actually flows into these stocks that you would be shorting because they're overvalued or there's some sort of problem. And so when you have these enormous money flows sloshing into like the S&P 500 index or the NASDAQ, it makes it really difficult to short stocks that are going to be going up just on non-discretionary buying. And I think that's something that the hedge fund business was very slow in responding to. Both those changes, the business should have responded sooner and found more innovative ways to adapt to what was a changing environment.
And let me pile on to that point, Gary. You're absolutely right. But one of the reasons that the indexing has grown so popular and why those asset flows continue no matter what's happening in the economy is because most of the asset flows into the public stock world are coming from retirement accounts, most significantly 401ks. People are getting their paychecks every 2 weeks, and every 2 weeks, 1 or 2 or 3% of their paycheck is going into their 401k and going into those stock funds. So whether the market is going up or down, the flows are going in. And so how can you short in an environment where there's constantly buyers all over the place?
The tail is definitely wagging the dog. Let's bring it home with segment 5.